This is the Alhambra Investments Weekly Market Pulse with Joe Calhoun. And I said the same thing last week, Joe. I'll say it again today. Man, have we got a lot of stuff to talk about. Things have really, really changed. I think one of the things that's on a lot of people's mind right now is the price of oil, because we've gone up about, 25% in a week?
Yeah, it was a pretty impressive move last week, 25% in 1 week in crude oil. Of course, it wasn't the only commodity up. It was a whole bunch of things up last week. Copper made an all-time high, and palladium was up, and I don't know, just a whole range of things. Wheat, corn, just a whole range of commodities went up. Ukraine and Russia both are big exporters of wheat, for instance, and so that's certainly having an impact. The move in oil was pretty impressive. I think that was there's been, and of course, we were up again this morning overnight when I was writing that. We were up about $8 or $9 last night. That has since moderated quite a bit because Germany has basically said they're going to keep importing gas and oil from Russia. I don't think they have much choice. And also maybe some movement by the Russians in their demands. That was a report out of Reuters this morning, but I don't know if it means anything at this point. I don't think it really does yet. But yeah, just these oil shocks like this are associated with recession, so they certainly get our attention. In our case, with the portfolios that we have, we do own commodities, so that portion of the portfolio has performed and done its job exactly as we designed these things. Some weakness on the stock side, strength on the commodity side, in this case, strength on the bond side too. You end up with a result where, last week the market was down. A 60-40 portfolio of just stocks and bonds was down, but we were flat to up a little bit. And frankly, we would have been a lot better off. We do own, unfortunately, some international stocks. So that hurt us a little bit last week. International got hit pretty hard. We still managed to close the week on a positive note.
Well, since we've got a rising dollar and we've got rising commodity prices, does that put us in a position for a recession pretty soon?
Well, look, it could. I was, in looking at the dollar, I have to say, this reminds me a lot of 2008. I remember the first half of 2008, our portfolios did fine. The market was not performing well. You had the Bear Stearns failure and so forth. But our commodity piece was making us look pretty good. And in the second half of the year, commodities just got killed because you had a recession. And that's oftentimes what happens with these commodity spikes. Commodity spikes tend to be self-correcting because they go up a certain amount and you kill the demand for them. In a lot of cases by having a recession, and that brings the price back down. So rising, it is kind of interesting. The dollar is rising at the same time you have commodities and gold rising, which is not a normal situation. Usually, like in 2008, we had oil prices rising, gold was rising, all the commodity prices were up because the dollar was falling. In this case, it's a little bit different. Geopolitical situations are different than just a weak dollar. And so, listen, is it going to cause a recession? One of the things that actually is surprising to me is the dollar is not stronger. The dollar index hit 99 last night. We're 98 and change this morning. If you go back to March 2020, you hit 103, almost 104. So, I'm actually kind of surprised it hasn't done better. And I'm not really sure why it hasn't, to tell you the truth. Except to say that most of the weakness in the dollar, most of the strength in the dollar index is because of weakness in the euro. This has been very much Eurocentric. We see the Canadian dollar, Australian dollar, Brazilian real are all up last week. Those are all commodity producing countries, so that makes sense. We haven't seen any real big weakness in other emerging market currencies. Some of the Eastern European ones, but they're not as big a factor in the dollar index. But does it cause a recession? That's something I can't really answer. I will tell you that the indicators that we follow, such as the yield curve, are not yet at levels that we would expect to indicate recession. Yield curve, the 10-2 curve still was hit 24 basis points last week, which is extraordinarily flat, but it is not inverted. It is still a positively sloped yield curve. We normally expect to see the yield curve invert prior to a recession. Hasn't done it. So we'll see. I don't want to overstate things. I think it's it's kind of scary watching this stuff. But right now we don't have indications that say recession is imminent. Put it that way.
What's going on in European stock markets?
Yeah, well, Europe's basically in a bear market. I mean, funnily enough, or not funnily enough, they are getting a little bit of a bounce over the last couple of hours. I don't know where they're going to close today. They don't have to close down very much, though, to be in a bear market because they were down 19% and change as of the end of last week. I guess that makes sense. I mean, look, they've got a surge of refugees coming in from Ukraine into Poland and Romania and some other of the Eastern European states. Natural gas prices in Europe are through the roof. I mean, we're talking up hundreds of percent. That's because they get most of their natural gas. A majority of, for instance, Germany gets over half their natural gas, or I think right around half their natural gas from Russia. Energy problems in Europe are going to have an impact on the economy there. And I think it's being reflected in the stock markets.
Well, the last two things today, you talked a little bit about what's happening in our portfolios. What are we watching as potential changes, or are there any?
Well, look, we had made a tactical move to initiate a position in emerging markets back in January. We did that because the dollar had some short-term weakness. That's generally what we do. We follow things in sequence, right? You get a little bit of a short-term weakness in the dollar, you add some international. If it continues, you add some more, and so forth and so on. Well, we never got to step two because it never weakened anymore. And now emerging markets really took a big hit last week. Interestingly, though, I mean, if you look at the emerging market index, it's actually still doing better than the S&P this year, at least as of yesterday, as of last Friday. So it's not a disaster, but in a rising dollar environment, we really just can't hold that. So it is likely that today or tomorrow, unless we get a rapid reversal in the dollar, that we're going to have to sell our emerging market position and take a loss. For the portfolio as a whole, it was a small position, so it doesn't have a big impact on the portfolio, but it's something that we need to do. So we'll clean that up. We do have some international exposure, international value exposure. That also is outperforming the S&P year to date. That I'm not sure about yet. That kind of depends, I think, on whether the weakness in currencies in particular spreads beyond Europe. If it does, we'll probably have to dump that too. Look, again, both of these are fairly small positions, so it's not that big a deal for us, but it's a tactical move that didn't work out. Look, all the tactical things that you do in your portfolio are not going to work. This one didn't. So we'll take our lumps and move on. It's much better to do that than to sit here and just write it down. I can't tell you what it's going to do tomorrow. I mean, it's one of those things, we might sell it today and tomorrow we get a ceasefire in Ukraine and all emerging markets go up. I don't know. I can't predict that. What I do know is if the dollar's in an uptrend, I got to minimize my exposure to international stocks. And so that's what we'll do.
And would that be the same advice that you would give an individual investor?
Well, yeah. I mean, look, international exposure is a diversifying asset. But in general, you're not going to see international outperform unless the dollar is falling. When the dollar is rising, you've got a headwind by owning international because by definition, you own a foreign currency. So if you're a dollar-based investor and you invest internationally, you really want the dollar to be falling or at least stable so that you don't have a headwind in your face. If you lose 1% on the currency, the stock market, wherever you're invested, could be flat. You still lose 1%. So that doesn't change no matter, if you're a dollar-based investor, it doesn't change anything.
Is the best advice at this point, wait and see?
Well, yeah, I mean, look, there's no way to predict this stuff. I mean, you can't predict what Putin is going to do. Geopolitical crises like this in general, if you look at the past, the effects of these things on stocks in particular tend to be fairly short-lived. And that includes some very major things. I mean, you can go back and look at the bombing of Pearl Harbor. The stock market recovered fairly quickly after that. So even things that last a long time, the initial impact on the market generally doesn't last. But we'll see. I'm not going to try to predict this. Like I said, there was seemed to be some movement this morning in Russia's demands to get to a ceasefire. But you know what? Does anybody trust the Russians? I certainly don't. They've violated every little ceasefire that they've had for humanitarian purposes. I don't think you can trust them as far as you can throw them. So I think you got to wait and see what happens here. I don't think that it's trying to guess what's going to happen it's just a guess. That's all it is.